Why is my video not starting? There we go. We're live. What's good, Debem? What's goody? What's goody? What's goody? Starting super on time today.
Good.
Let me just post this out in the groups.
All the dump. So you saw the price go down.
I've literally not even checked the markets today.
Oh wow.
I'm a bad guy. I've not even done that yet.
Yeah, I think what they were saying was to do with Binance pausing the withdrawals or halting the withdrawals.
Oh, did they do that? Oh, that would explain, because I was trying to do some withdrawals on Swissborg today and it wasn't happening.
Yeah. I think that's what's going on. There was a huge delay. Like there was a lot of things happened. There was a lot of delay happening. Did you try to do this today or over the weekend?
Yeah. I tried doing a withdrawal today and it just wasn't happening.
That's what. So people start. I think that's what caused the sell-off. So people are panicking, and yeah, that's what's caused the sell-off. But I think it's all fixed now. So I think it's rectified. But yeah, that's what caused the sell-off. That's
you
what.
Never know. You never know. Let's see. Hey up, Oscar. Hey up, Jerome.
Hey, what's happening?
Oh, good. How is everybody? Welcome.
What's good?
Just posting up.
All good. Just walking the dog while I'm tuning in. Didn't want to miss out.
Oh, I didn't know you had a dog.
I don't. The family does.
Oh. Oh, no, your filtered background's on. We can't see him. Oh, there we go.
Hello.
Oh, hello, little chihuahua. I did not have you down as the chihuahua. Hi, Oscar.
No, you know that ain't my dog, right?
Yes. What's good, people?
I'm never gonna let you live that down, you know, Oscar. I'm
My
now
kid's
gonna ask what's your chihuahua's name?
It's a terrier mixed chihuahua. Max.
Wait, what? You got a chihuahua?
Yeah, Oscar.
No. I don't have a chihuahua. My children have a chihuahua. Anyway,
Let's got a chihuahua.
Stop making fun of me and start dropping the alpha. Come on, I'm ready to keep on some food.
So we've got to know the name now. What's is it a boy or is it a girl?
It's a boy, Max.
Max.
Okay. Cool. Okay.
Maximum size, as Dom says. No, wowzers. Right. I'm gonna just make you host, Ninja, because I've got to switch to the iPad.
For sure.
I don't know.
The disclaimer.
Yeah, if someone wants to run the disclaimer as well whilst I'm switching to the iPad. Do you want to do that, Ninja, whilst I just switch?
Yeah, I'll do that.
Cool.
Okay, what's good, people? It's your boy Ninja, aka Fadlan. My co-founders Michael Harding and Keash and Rig. Welcome to another episode of The Game. It is currently 4 minutes past 8 p.m. UK time, Monday the 8th of May 2023. Every single Monday 8 p.m. to 9:30 UK time since 2020 we have been doing a free weekly webinar called The Game, where we cover stocks, crypto, market updates, live technical analysis, with special guests, etc., you name it. To join this free webinar, click the link in the blockchain.sensei Instagram bio. Please look out for fake profiles. Please check how to spell blockchain and how to spell sensei, because these fake profiles typically spell sensei incorrectly. And yeah, just click the link in the bio to join the Zoom. And free replays on YouTube, like, comment, subscribe, etc. So quick disclaimer, terms and conditions: all content is for education, information, and entertainment purposes only, and should not be considered as investment advice or a recommendation to buy, sell, hold any assets, nor place any trades. Please always do your own what, guys?
Research.
Our content is intended and should only be used for informational use only. Therefore, it is very important to do your own analysis before making any investments, which should be based on your own individual circumstances. As always, please pay your bills, pay your debts before.
Can I throw
investing
something in
decisions.
on this one? Because this is an episode that a lot of financial advisors might dump their partnerships with us for. So this is also an episode based on entertainment. So yeah.
Yes, we try to be very entertaining. So you should always take independent professional advice from a professional advisor, especially with regards to this episode, because we're basically kind of attacking financial advisors potentially, because a lot of financial advisors like to advise people to get pensions in the UK. And we're not saying don't get pensions. We're just saying these are reasons why you may not want to deploy so much in a UK pension fund. Or independently research and verify all and any information you may find in our show that you may wish to rely upon, whether you wish to make an investment decision or otherwise. All investments come with what, guys?
Risk.
Therefore, please do your own research. Neither
Research.
myself, Michael Harding, Keash, Oscar, who's a legend, co-founder of DLT, shout out our friends at DLT Hub, St. Jerome, check out The Chop, which is a series that we do, Dubham, and Mimi Do. I'm assuming Mimi Do is not a financial advisor either, and everyone else in the room. However, we are working in collaboration with several accredited advisors. If you're unable to mitigate your risk, please contact us immediately so we can refer you to an accredited financial advisor. On this episode of The Game, we'll be covering arguments for and against UK pension funds, because we believe that people should be very considerate on how much they do put in their UK pension pot. Over to Mr. Harding.
Okay, so yeah, we basically need to do the disclaimer all over again because this is a very, very touchy episode. We just have to reiterate: this is not financial advice. This is just entertainment and education, and we're just going to provide you some facts, and it's up to you to go and do further research, make your own decisions, and ultimately speak to a financial advisor. Now, this episode is inspired by a lesson I had with a student quite recently. Now, a lesson I had with a student quite recently, we were just looking at the average annual returns that someone managing their own investment portfolio is capable of getting from the markets. And we agreed, if someone really pays attention and looks at their portfolio on a weekly basis, does the technical analysis, does the fundamental analysis, listens to the earnings reports, they could probably get between 30 and 50%. Type yes in chat if you agree. I want to make this episode a little bit interactive. So yeah, type yes in chat if you agree that 30 to 50% per year is what a self-managed individual that's financially literate, not just some random hoodoo that's just investing in things because their friends have said. I'm talking people that are doing their research and they've met the requirements, that they're looking at their portfolio on a weekly basis and are reading and listening to earnings reports from the things in their portfolio. So based on that, we then looked at, okay, so how much could someone deploy? And it was based on the idea of, over the course of a year, really fully maximizing your investment ISA that every UK citizen has available. Now, if you don't know what a UK investment ISA is, it's an option that's available on literally most investment platforms. Now, we often presume that people know this exists, but I've come to realize, never presume that people know anything. An investment ISA is available on Free Trade. It's available on Trading 212. It's available, I'm pretty sure it's available on Revolut. And if you contact us, we've actually got some contacts that can allow you to have an investment ISA for your crypto. Now, why is this investment ISA so important? Because what it allows you to do is to not pay tax on the gains. Repeat that. Not pay tax on the gains.
The gains.
So let's say you put in £20,000, so you reach the ISA investment limit, and you get 100% return on that investment in a year or in 2 years, right? That means that 20,000 is now worth 40,000. If you were to take that out, you now pay 0 tax on that.
Yeah.
Whereas if you don't use the investment ISA, then you will be paying capital gains tax. So that's the first area of why this was of interest. Now, then what I'm going to get Ninja to do is if you can pull up the compound calculator, and we'll just
compound calculator. Let's
show
go,
you this.
sir.
Oh, that's my favorite thing.
And I mentioned this, well, not specifically the compound calculator, but the power of interest in the tweet string.
Oh, sick.
Calculator.
Yeah.
Anyone in particular?
Second one
This
there.
one.
Yeah.
Okay, so we're going to use the model that I said. So 20,000 for the year would work out at roughly around £1,500 committed per month. Now, between a couple, so that's 2 people working full-time jobs, that would mean that you'd have to put aside for your investments £750 each. Now, in this scenario, it's a scenario where someone doesn't have a mortgage to pay, because if you have a mortgage to pay, it's probably going to be a little bit more difficult for you to pay that. So we're going to have no initial investment. There's no initial investment. All it is that per year you make a 50% gain. So put that yearly and 50%. And then years, we're going to do that for just 10 years. Now, most people are working for between the ages of 18 all the way up to 68 is the current retirement age around that area. Now, that would actually be what? How many years is that? 50 years? 60? 60 years, right? 50. But we're not even going to look at what would happen if you did this for 60 years. We're going to do it just for 10. Now, the reason why I'm going to say for 10 is because in the last bull market that we had, last macro bull market, they normally last between 7 and 12 years. So this is realistic. So 10 years, and your deposits amount is going to be 1,500 a month. So not there, down below, down. Deposit. Yeah, 1,500. Yeah, and then leave that, and that's it. Yeah, and I'll calculate. And let's look. Put 0. And calculate. That would return a total of 4.7 million with no tax to pay after 10 years. I just want to start this conversation off like this.
Yeah. That's 10 years of consistency.
10 years of consistency. 10 years of getting a 50% return on your portfolio, with a portfolio that has a combination of stocks and crypto. Because I think to get the 50, you're going to need to do that. Now, that's just
and also it's worth noting that this £4.7 million return would only cost the individual £108,000 of actual capital.
And that's why it's important to show this, because I think this makes it more realistic for people. A lot of people don't go for a long-term portfolio because they're trying to get rich quickly. Yeah. Now, if you knew that this was possible, you wouldn't be trying to get rich quickly. You're just going to stick to your plan. And your plan is going to be, all I've got to do is invest £1,500 a month for 10 years and get a 50% return. And I got 4.7 million. Now, even if you don't do it in 10 years, if it takes you 20 years, is that fair to retire on to get to? Yeah, because then that 4.7 million, you can put that all into a stock that's going to pay you dividends on it and just live off it.
Yeah.
So that's where I wanted to start this with. Ninja, do you want to go into your tweet string, and then I'll just support you on with my notes that I've made?
Yeah, I think
yes, sir,
Also, to add to that as well, like with the dividends thing that you're saying, you can do that with 1 million. You can live off putting 1 million in one thing and living off the dividend.
Yep, 100%. But unfortunately, most people try and go for a dividend play when they've got a couple of grand. It's
exactly.
not how you do it. That's not how to play the game, in my humble, non-financial advice, non-expert opinion.
In your entertainment opinion.
Yeah, in my entertainment opinion and my personal actions, that's just not what I'm trying to do. So yeah, Ninja, do you want to go ahead?
Okay, let's go. Let's go with the tweet string. This tweet string will be available forever on Twitter, so feel free to engage if you're watching this in the future with the tweet string. It'd be great. So big ups to our homie Sasha Yanshin for providing some of the sources of these notes. So here are some notes on possible arguments against why you shouldn't invest in UK pensions and or consider investing less into UK pensions. Okay, let's go. So for some people, pensions won't be the optimal path. So one argument for pensions is that, so one argument for pensions, this is the typical argument that people say, is that they say you pay into your pension before tax, which sounds very appealing. For example, if you happen to be lucky enough to be a high-paid employee on 40% tax in the US or UK, for every $100 or £100 that you put into your pension, you're only paying in 60. The problem is that you pay tax on your pension in the future, delaying on tax later. Now, fundamental lesson in finance is, which is I'm sure you can correct me in the exact phrase, Mr. Harding. It's a repeat. History doesn't repeat itself, but it rhymes.
Yeah.
History doesn't repeat itself, but it rhymes. Now, most people forget that it was less than 100 years ago that the world was at war. The entire world. People forget that countries like Pakistan and Bangladesh did not exist in the 40s. It was all India, right? So the world works in cycles. Shout out to Ray Dalio. Changing world order. Everyone go check that out. I've lived on this earth for nearly 28 years. Michael Harding's lived on this earth for nearly 33 years. So, yeah, 33 years. I forget exactly. And we need to pay attention to the cycle of where we are now and historically how history can repeat. So the problem is that you pay tax on your pension in the future, delaying on tax later. Another problem, I'm going to get to this paying tax in the future. I'm going to get to this in the next few tweets. So another problem, comparing the 20 to 30-year-old contributing to the pension right now versus that person being 65 to 70 years old. What will the world look like in 40 to 50 years? Well, the world has already changed a lot in the past 5 years. The world changes faster. The world changes more in a shorter period of time as time goes on. I'm sure we can all agree on that. Yeah. So we're hyper accelerating.
Wait, let's make it interactive. Type yes in chat if you believe that the world is changing.
Oh man, what a time we're in right now. We've got everyone in chat saying yes. Yep, you're damn right. Got a capital yes.
The world has changed. The world has changed since the start of the year.
Yeah.
I seldom use Chat GPT in 2022, and now it's like I can't let the tab go. Yeah. I mean, I've cleaned my tabs for the sake of this webinar, but everyone who knows me personally knows me and Keash, for example, have like 500 tabs. Right? Yeah. And Chat GPT never leaves. It's static. It's just there. So my world has changed in the past 4 or 5 months. So we can only imagine what the world will look like in 40 to 50 years. And yeah. I do not like the idea of my money being locked up for 40 to 50 years. So in 1945, in World War II, this was World War II, the top tax bracket in the US skyrocketed to 94%.
Jeez.
Those who were earning $200,000 plus were getting taxed 94%. Obviously, not on the 200K, but on a certain threshold, right?
Yeah.
Now, now you would think. Oh, sorry. Just to add to this, pre-World War II, so pre-1942 or 1941 or something like that. Basically, in the 30s, right? In the 30s, a few years before World War II, the number of US citizens paying tax went from 7% to 64%.
Mad. 7, you know.
So that's like 9, that's over 9x. 9 times 7, 63. So the amount of people paying tax 9x'd in half a decade. And this was World War II times, right? Where things were moving at a snail's pace in comparison to where the world moves now.
Yeah.
You would think that, you know, since recessions, etc., typically don't last for more than a few years, you would think that surely after World War II, 4, 5, 6, 7 years later, things would improve because, you know, countries became, countries such as my own country, Indonesia, became independent. 1945 was a very historical time where many countries, including my own country, Indonesia, and Pakistan and Bangladesh, became independent, right? It was a very key time in human history for those that aren't aware.
Yeah.
You would think that they would improve within a few years. Well, ladies and gentlemen, between 1945 and 1960, the tax rates increased during the period for many Americans, particularly high-income earners. So between 1945 to 1963, for 18 years, this is why humans are so quick to forget shit, right? It was a minor language. For 18 years, taxes in America were astronomically diabolical. And finally, in 1964, so for 18 years, people were getting taxed up to 91% over a certain threshold. Mind you, there were high earners, hundreds of thousands. But 1 year later, in 1964, it dropped to 77% as part of a broader tax cut. Right?
Whoa.
So, right now in the UK, just like the market is in a bear market and a bull market, a bear market and a bull market, things go up and down. Guess what also goes up and down? Tax.
Yep.
Tax goes up and down, right? People don't talk about this because tax in the UK has been relatively stagnant for for the past. Well, in my lifetime, in 28 years of living, the tax has been relatively low, especially on pensions. However, just because it's low now doesn't mean it can't be low. It can't be high in the future. And historically, things go up and down and don't stay stagnant.
Yeah.
So because UK tax is low right now, there is a chance the tax will be high in the future, especially if you retire just before a war.
Oops.
Oops. So both UK and US employers are obliged by law to offer some kind of workplace pension scheme, which employers must contribute to. However, there is no law saying employees must match what their employees are putting away. For example, if an employee who makes £30,000 per year puts away £60 per month in their pension fund, employees are not obliged to match it, as in pound for pound. As of April 2021, the minimum employer contribution is set at 3% of an employee's qualifying earnings, while the minimum total contribution, including both employer and employee contributions, is set at 80% of the qualifying earnings.
8%.
Also find the same.
So it's 8%. So if the average person is making about 30 grand a year, that means that per year they're contributing, guess how much per year? £2,433. Yeah, £2,400, which if in the grand scheme of things, you're expecting to live a comfortable life, retiring on your pension, and you're contributing £2,400 a year, you're probably spending more on holidays, probably spending more on clothes, on everything than your retirement. Do not, under any circumstances, expect to retire comfortably. I think it's obscene.
Yeah, I think it goes back to the little chat that we had, man. I mean, when I think of pension, I think of, you know, someone just going to the market for apple, then going to the Thames to do some fishing, then maybe, you know, you might be going to the park, do a bit of bird watching, add another feather to your collection. That's your day.
Yep. And now this money that you put in, right? You're now expecting this money to grow, right? So this £2,400 that you put into the pension. And Ninja, if you open up the Blockchain Sensei Instagram, I've just tweeted pension fund performance of 2022.
Sorry, you tweeted up.
Yeah, no. Yeah, it's here. So it's the next image, not this one. Go to press the arrow, and again. Yeah, there we go. So let's look at these performances of these portfolios, of these funds. Oh, for a year, minus 1%, minus 5%, minus 4%, minus 7%, minus 8%, minus 14% from now pensions. And then after 5 years, they can get you a whopping 11% or 28% return after 5 years. Now, we've got students that have accidentally made 30%, 40% because they invested in just Apple and forgot about it.
In like 3 months.
Mm-hmm.
So, yeah, just ask yourself, like, the retirement that you imagine, is it possible on these kind of performances? Now, those performances have not even included inflation.
Yeah.
So if you take 11% inflation of this year,
about to say that it's like this 1 year. Let's take the middle one, for example, Nest, which I actually have a little bit of money in this because I had a job many years ago, 5-6 years ago. I should check up on this, but it's minus 7%, but inflation's gone up by 7% or something like that, right?
it got to 11.
Actually, sorry,
it got to 11 at one point.
It got to 11, right?
Yeah.
So this is more looking like the God save the people who are retiring in 2023 with Nest, because the loss that these people have taken is crazy. God forbid the people who got into, for example, Nest and Legal in General and Scottish Widows. I'm sorry, guys. Like 5-6 years ago, they started a job at 58, 59, and then they retired a few years later. They're taking huge losses right now.
Yeah.
They're getting smacked in the face.
Where if they followed our 10-year rule,
that's
it's
it.
a bit different.
You're good. It's a bit different, definitely. We got someone in the chat. We've got Asante saying, wait a second, don't they trade with your pension fund?
Yes, they trade with your pension fund, but they don't do very well with it because they trade. Guess what they trade with it? The FTSE. So
my favorite index.
So do you want to pull up the performance of the FTSE for the last 10 years?
Yeah. I like looking at it. This is my daily meme.
City of London is trying to gain approval to use 50 billion from pension fund to help startups in the UK. Well, they need to, because it's a shocker.
Yeah.
Yeah,
and there's even more things that are even worse, but I don't know if I should be mentioning them, so I'm just going to keep quiet.
Yeah, they're
Go on. Say what you have to say, bro.
You might have to do a different one because this one only goes that far back. It only goes back to
I thought so. FTSE.
FTSE, yeah. And then go Go UK 100, it will come up as.
Oh,
Yeah, there you go. Try that one.
this goes up for 2014, which is 9 years.
Yeah, it's 9 years.
I wonder why.
Well, either way, you can see that in the 9 years, you would have made 16% gain on your pension money, and inflation in just 1 year was 11%. So
Wait, the same 16% gain that happened 5 years ago. Spin. So the gain was here, and then since that gain,
I think it's pretty safe to say you made no gain over the last 10 years.
yeah.
Because
If you count inflation, yeah.
if you count
2020 that,
inflation,
innit?
it's just you've literally wasted 10 years of contributing your pension.
Yeah.
Some financial advisors would say that you haven't. But if you were retired, if you were thinking about retiring 10 years ago and you were like, right, in 10 years' time, I'm going to retire, let me increase my contributions to my pension, and your pension was deploying your funds to the FTSE, yeah, it's a bit peak.
Yeah.
No gain zone.
Okay,
Yeah.
so this applies globally, to be honest, and it doesn't just apply for pensions. This applies to anything that requires requires a financial service and speaking to someone. You must remember that these. Oh, sorry, that was more the next point. Okay, cool. Ignore what I just said. Another reason to maybe not find out, I'm going to get back to that other point in another tweet I just misread. So another reason to maybe not invest in UK pension funds, or as heavily as is typically recommended by the vast majority of people within the UK system, is that the vast majority of pension schemes are very restrictive and stupidly risk averse. So right now, out of these providers, most of them, if not all of them, have the portfolio in low yield bonds that don't beat inflation, cash, and also the FTSE 100. Recommended watch is Billions on Amazon Prime, because you really get to learn.
Oh man,
you really get to
before I jumped in.
Learn, about why things are the way they are in terms of politics and asset managers and incentives and bribery and this and that. And I think, this is just conspiracy now, I think that companies in the top 100 have some kind of business deals with these kind of pension providers, not naming any specific names, and like some kind of back-end commission referral scheme.
Of course there is.
That's a fact, bro.
Where it's all tied together.
Bro,
it's like
no, there's all this money sitting in pension funds that bank traders are definitely trading, bro. Without a doubt.
I think, if I've got a pension fund kitty, let's say I'm Legal and General or whoever, and I got a pension fund kitty of like 100 billion, and I go to you, right, you trade my 100 billion, I'm going to put my pension, all my employees' pension fund with you, right? And then I'm going to give you, for every 1% you make, you can take 10%. 1% of a billion is still 10 mil.
Which is a lot of money, my friend.
But the calculation was based off 10 billion. So it was 1% of 10 billion, still 100 mil.
Yep. Yeah.
So
that, that's how it is. These traders they have huge salaries based on success. But then also they're trading with leverage. That's one other thing. But,
and that went horribly wrong this year.
It did. But let's not get too deep into that. But they're also trading with leverage.
with your pension.
Oh yeah. I forgot
That's
to mention
crazy.
that part.
So anyway, so this was the point that I made earlier. Not just pensions, but mortgage advisors, accounting, financial advice, tax rebates, everything to do with financial services. Remember, you are speaking often, not always, but often, to a salesperson. And the thing is with salespeople in finance, it is quite difficult to identify, or it can be challenging, especially if you're not in this world, who is the salesperson and who is the expert. The problem with a lot of people at UK pension firms in terms of the customer facing ones is that they're salespeople who are incentivized on commission schemes.
Mhm.
Now, in my opinion, this is completely immoral, because you're basically convincing somebody to tie up their money for up to 50 years. And imagine working a job where you got commission one time to convince somebody to lock up their money for 50 years. I don't think that is the most ethical business model. So yeah, basically when you're picking a pension, you're speaking to a salesperson. They want you to type your money for 40 to 50 years so they can get a quick buck and forget you after their sales commission. So here is a crazy stat from our homie Sasha. The S&P 500 has typically done around 9% a year. Obviously not this year, but throughout history. And a lot of people, just like I said at the start of somewhere in this tweet string, I said that some employees will match you 50%. In the UK, employees must match you by I believe 60%, going off the numbers that 8% for qualifying earnings, while the minimum employee contribution is set at 3%. So then employees must put 5%, right? Anyway, the S&P 500 typically does 9% a year. Even if you had a high yield pension that gave you 7% per year, which is very, very rare, and you had a nice employee that matched your contribution. Let's just take this basic example. Let's say, I'm going to use very, very small numbers to make this easy to understand. I'm sure everyone's able to scale up these numbers. Let's say you put $1 in your pension, and you had a super nice employer that matched that $1, so you got $2, and that's 7% per year for 50 years. That would turn into $58.91 if you just left that $2 at 7% a year for 50 years. However, if you just put money in the S&P 500 without anybody matching you at 9% per year for 50 years, you'd have $74, even though the starting capital was 50% less.
Mad.
That's the difference between percentages. That's the difference between the tiny increments of 7, 8, 9%, which ties in with compound interest, which we covered earlier.
On that one, I'm going to get you to go back to the Instagram bits, because there's an image that I put out that's related to this as well.
Yeah.
I think it's left. I think it was before this. Back again. Oh no, it's that one. Go right. Okay, so this is comparing money invested and where it's invested. So as we know, most of the UK are obsessed with property and want to put their money in property. Fair play. It's each to their own. Now, when you do the maths and you look at the stats, I'm going to read an article from Schroders. A further shadow is the faith that many Brits put in property as their pension. Anyone who has read the money section of a Sunday newspaper will be familiar with the question regularly posed in celebrity interviews: which is better, property or pension? In all but a tiny minority of cases, the answer comes back property. So most people, what they're planning to do is their nest egg is their property. So they plan on, when they retire, they've got their property, and then maybe they'll sell their property and live off the gains from that, which is completely fair enough. If you were born in the 1960s, if you were born after the year 1985, it does not make sense for you to do that. just because of the stats that I'm going to get into. Bear with me. My personal opinion, not financial advice. So that's because house prices have tended to rise over time, but they don't represent the same equal amount of portion of what it is for someone's wages in comparison to the actual eventual house price. So if you just go back a slide, an image, it kind of displays it. No, not that way. Yeah. So this is showing the house prices versus the multiples of your earnings. So we can see between 1969 and around 1999. So that's a good, what, 30 years
30
almost?
years.
Yeah. People in the West Midlands, their house prices were just around 2 times their yearly salary. So from 2 years of their yearly salary, they could buy a house. So if your yearly salary was 30K, you could buy a house for 60K. Yeah. And then we can see the highest bracket of that in the 1980s, that got to about 6%. Average was around 4. So 4 times your annual salary to buy a house. Now let's look at anyone born after 1985. And if you're not on the property ladder now, you can see that it's kind of coasting around the 10 to 12 times your wages, especially in London. So the idea of that being disposable income, you've got to really ask yourself, is there an opportunity cost of you plowing that money into a property that you just got to really do the research. I'm not going to say too much on it because people don't like this conversation. And I don't want to get any haters. But there's a Facebook status that I did in 2012 when I first started getting into investing. And another one that I did in 2018, and another one that I did in lockdown, saying to people that, in my personal opinion, it's better to invest into the stock market than it is to invest in a property. At that point, I decided to invest in Tesla. Some people decided to get houses. Now, Tesla has done well over 10x, well over, since I first started investing in. I don't know many houses that have done a 10x in the last 5 years.
No.
And I don't know many houses that have done a 10x in the last 5 years that people have not had to pay tax on.
And I don't know any houses that you can clip profits from. See, this is what people don't talk about as well. With digital assets versus physical assets. With a digital asset, you can sell it in part very easily.
Mm-hmm.
You can buy it back very easily. How difficult is it to sell? Imagine buying a house for £200,000 and then it goes up to £500,000. Well, you can't sell 2/3 of the house, can you? And keep a third. You got to sell all of it.
You got to remortgage. You got to remortgage. And then this is the biggest problem with this, is the interest rates are not fixed for the entirety of your mortgage. So this is the bit that, for me personally, I just can't sit with. I just can't sit with a deal where someone's saying to me, yeah, you know what? You're going to pay an extra 4% a year, which after 20, 30 years works out that you paid an extra 40% for this 200 grand house. So I'm basically paying an extra 100 grand for this 200 grand house. And then I'm going to have to pay tax when I go to sell it as well. And it's just like, and then that interest rate can move as well. And the highest we've seen the interest rates on properties in the 1970s, it gets above 20%. So for me, I don't want to get tied into something that I don't have control over if I'm paying more.
That's like fees, brokers' fees.
Yeah, that's like someone saying to you, right, here's a phone bill, right? You're locked into this phone bill for the next 40 years, but we can increase it by whatever we want when we feel like
Whenever we want. Yeah.
Nah. Nah.
And then, do you know what? I don't want to make this all about property, but I must bring this up. Is anyone here aware about the noughties, so 2000 to 2010s, land registry scam?
Nope.
Okay, I'm gonna explain to you guys, because unfortunately my family fell victim of this as well. So the family home which we own in Manchester was purchased in 2009, 2010, that kind of era, right? And it was in the small print. There's loads of people who bought houses around that era, around the 2010 era, 2008 to 2013, I would say, in the UK. And then swiftly around 2015, 2016, they made it very, very illegal for this to be so. But anyway, you can look this up. It's called the land registry scam. So it's basically where we got sold a property, which, mind you, has done extremely well. It's done like 2x in the past decade, which we're very grateful for. But we don't yet own the land it's on.
Mad.
Oh my God.
And
I've heard about this. I have heard about this. This is a big thing in Birmingham.
We didn't know that we didn't own the land till half a decade into the property. And guess what was also in the small print? The increase of the land registry. So had we understood and had we been informed by our estate agent during the time, which I won't out during this Zoom because you got to keep friends, right? Had we been informed, the land registry would have been a mere 2,000 to 4,000 without exposing how much it is now. It's ridiculous.
Mad. And then the worst bit with all of that is most of the time with this land registry thing, because it's a huge thing in Birmingham. The easiest way to add value to the house is to add value to the house. So you add an extension, you convert a garage, you convert a loft. Most of these houses, despite the increase in interest, you have to get permission to do anything to it.
Yeah.
Because you got the land.
And it's yours. What do you mean? That doesn't even make sense to me. But anyway, let me finish my point.
Planning permission. You can
go back to that image and let me the other one. So not the price of earnings. Yeah. So yeah, house prices have tended to rise over time. So it's not hard to understand why people say this. 100 grand worth of UK property 25 years ago would be worth an average of around 454,000 today, and then you'd get taxed on capital gains tax when you sell it of around 40%, depending on the value of the house. This obviously varies by region. In London, it would be worth around 580,000. In Scotland, 407,000. These figures exclude any cost of ownership such as maintenance, repairs, insurance, or taxes, and any income generated by the property. However, the same 100 grand invested in the global stock market, excluding any cost, grown to 631,000 pounds. That's an extra 200k for doing the exact same thing that if you've done it for a tax ISA, you pay no tax on. This is almost 10% more than the top performing regional market. Furthermore, it doesn't matter where you look over the 5, 10, 15, 20, 25, 30 year horizons, the stock market would have always resulted in a bigger increase in your 100 grand compared with UK residential property. Let me just say that sentence one more time. Furthermore, it doesn't matter where you look over this 5-year, 10-year, 15-year, 20-year, 25-year, 30-year horizons, the stock market would have always resulted in a bigger increase on 100 grand compared to residential property, plus not having to pay tax on the gains. Yeah. So that's my bit done there.
There you go.
Yeah. So
that was Schroeder's, by the way, not me.
Last two tweets. Getting higher yields, especially for pension tax. Yeah, when you're looking at a long time frame, it's important to get higher yields rather than a larger capital. So yields higher yields, slightly higher yields are very effective over the long term. Slightly higher yields are more effective than more capital and a slightly lower yield over a long time horizon. Good example being $2 at 7% per year for 50 years equals $58. $1 at 9% per year for 50 years is $74. However, this logic only applies to under 30s. If you say 55 and you're putting into a pension pot and you have a very, very nice employer that is matching your pension 1-to-1, it might be a good idea to go with that. The reason why this is very important is because most of our audience is under 30s.
However, I have to say, if you are doing that, please find out what assets your pension fund invests into, because as you just said, if they were investing into the FTSE for the last 10 years, you didn't really
boy.
So this is why financial literacy is important for everybody. And then Ninja, if you go and do the icing on the top and just go on Google and look at the average national pension.
Oh God, are we doing this again?
Yeah.
Oh God.
No, not the performance, just the amount somebody has.
The amount, what the actual pension is.
Average pension.
Average pension.
No, just get rid of fund.
Yeah, put in the UK.
UK.
Oh God.
18 grand per year. Now, I don't know where. Definitely not in London. You're not surviving off that.
Yeah.
Like strugs. But yeah, it's a bit mad. Is there any more tweets, or is that it?
No, that's it.
Okay. And then final thing, go back to that Instagram image. There's one more thing. One more thing. Well, two more things. So the other thing is the fees that go back to the Instagram post where it's got that. Yeah. So, and that one there. The other thing is the fees that the pension funds are charging you. So that's the other thing. Now through Investment ISA, depending on which account you're using, you can just pay $9.99 a month rather than paying a percentage on all the money that's in there. So I personally would rather pay $9.99 a month for 50 years than pay a percentage of my total pot. So as you can see here, it looks like let's just look at the amount lost. So you can see you can be losing out on 50 grand if you're getting charged 1.25%. So yeah, it's very bad. And then the final thing is that the whole thing is taxed. So your pension, which most people don't realize, is there's actually a lifetime allowance of how much you're allowed to put into your pension pot of just over 1 million. So what happens to the rest of the money? It gets you get taxed. 25% of it is tax free of your 1 million, so around 250k. And then 55% tax is what you pay on anything over the limit. So let's say, for example, every £1,000 you had, you actually get back £450. So you know how it was already bad performing? You're then going to get taxed. And then if you take it monthly, you're going to get taxed 25% on it anyway, because you've got to pay income tax. Whereas if you use an investment tax ISA, you pay no tax. So yeah, just for I'd raise that point. And ultimately with a pension, if you end up having some kind of medical issue and you need to take that money out, you can't take it out.
Because you're not old enough.
If you have some kind of issue where you need to pay for a house, or God God bless this doesn't happen to any of our callers, where you are told your life expectancy isn't going to be 70, 75, 80. It's actually going to be 60 or 50. And you want to take out the money that you've contributed so far. Unfortunately, it's going to be very difficult to do. If you want to move country, very difficult. If you want to buy a new house with your pension money, very, very difficult. So yeah, just thought we would educate our community on something that isn't really spoken about anywhere. And after doing that little bit of maths about the 1,500 and putting it into your investment ISA and managing your funds yourself, then yeah. So Ninja, do you want to go to TradingView real quick?
Yes, sir.
I just want to drum this home. So let's go to some key stocks. So let's just even go to PayPal. Let's go to PayPal.
Ninja's number one stock pick right now.
Let's go to
For financial
PayPal.
advice. I'm have to just search it. I can't find it. Somewhere on my watch list.
Yeah. Okay, so PayPal's getting absolutely smacked up. Go to the weekly. Yeah, and then go to the and then add the 200 moving average. So we all know about this rule, the 200 moving average rule. So if it's over the that's 20. You've done 10, 20. Oh, you're doing all of them. Just do just 200, just 200. So take all these off. So take this whole thing off. And then just search moving average 200. You can just type moving average and then change it.
It's fine. 50 and 200. Let's just pay attention to 200.
Yeah.
200 is the red one.
Okay. So what you would have done is you would have sold at the moment it went below the 200, and then you would have bought the moment it went above the 200. So you can see PayPal, you would have got out there and you would have not had the big losses from there all the way down. So let's go to Apple and follow this exact same technique on Apple. You should have Apple in here. Yeah, here we go. So there we go. We can see if you got in when we went above the 200 moving average, which would have been, mark off. Find out what the percentage gain is from when we went above the 200 moving average to when it next dipped.
What, you mean like here?
Yeah. So that's what? 254% gain since 2019. Just from following that one simple rule. Just from following the 200 moving average rule on Apple, you've made 254% across 5 years versus a pension fund doing 20% across 5 years. Okay, just to show that it's not a fluke, let's go and do my baby Tesla. And if we follow that exact same rule again, if we go from when it crossed over the 200 moving average, here, all the way to when it crossed over again, 971, 10x gain.
11x, mind you, 2022.
Yeah. There is no pension fund doing that. Was that hard to do that analysis and follow that rule?
Nope.
Could somebody do that on a monthly basis?
Yes.
So the rest, guys, is up to you to do your research and go from there.
There you go.
Yeah. So let's take some questions before we bounce and wrap up. Most people, unfortunately, not disciplined enough to follow stocks and know when to buy, sell. Is it worthwhile to use an ETF as an example? Yeah, you can use an ETF. Do you want to quickly show that on the Nasdaq, the 200 moving average on the Nasdaq? Again. Oh, that crossover has not happened in a while.
Oh yeah.
So yeah,
It's
since
May
2000.
2010.
Yeah. So yeah, do the gain on what that would have been.
It's just about crossing over now.
Yeah, 600% in 13 years, which still is blowing what your pension's getting out the water. It's blowing. That's just the NASDAQ blowing what most properties are going to get you out the water. That's just the NASDAQ, let alone Apple. And we're not even, do we want to do Bitcoin? Type yes in chat if you want to see it for Bitcoin. Big capital yes.
Big yes.
Go on, let's
Greatest
do it for
performing
Bitcoin.
asset of all time.
Just this simple rule of get in when it's above the 200 moving average, get out when it's below the 200 moving average. On the weekly or the daily, you can use this technique. And we can see it hasn't really ever dipped below that. But okay, do it on the daily to the 200 moving average. See, we're even having to try on purpose. There we go.
So the crossover was here.
Yeah.
2020.
It crossed over before that.
Yeah, but I can't get it on the screen for the daily because it's not side of width. One sec. You mean like here?
Yes.
Was it the first time it ever crossed ever?
No. So the most recent ones. So most recently, when has it crossed under the 200? So it most recently crossed under it around the 44,000 mark. And it most recently crossed above it around the 18,000 mark.
Wait, so where do you want me to go from?
So go from July 2020. Yeah, I think it's safe to say it crossed over there.
Mm-hmm.
And then go to, I think it's safe to say there, yeah. 385%. That's
Just
in
like
1
that.
year.
Yeah.
That's in what? So just following this one simple technique on Bitcoin alone gets you a better return than any pension fund can in 30 years. So yeah, do your own research, guys. We are not financial advisors. We're not telling you what you should do with your pension. We're just bringing some facts to the table and giving some strategies for you to look at and do your own research on to manage your own funds.
Exactly.
Yeah, guys. So that's that. Oscar, definitely the trading lessons and the trading sessions. Definitely, that is a big thing we're thinking about doing, guys. If you don't know, Oscar is one of the best traders I've ever met in my life, and definitely going to be getting into working out some kind of educational thing that we do with Oscar, and have like a weekly or a drop-in center for traders where they can just a trading community where people trading crypto and stocks can just come and share their analysis and get feedback from other people, and that's something that we're going to be putting together, so watch out for that. Cool. Is
one
there
thing
any dying questions before we leave?
Not a question, but one thing I would like to add as well, definitely speak to a financial advisor, because they have, from my conversations I've had with financial advisors, there's certain pensions that they don't tell you about that are better than these ones, and some that we've discussed, which is obviously, I'm not saying load the boat, but I'm saying that there are options out there that are not necessarily public knowledge, and that's why you would need a financial advisor for that. But other than that, that's it.
You know what? I think we should change it. definitely speak to not a financial advisor. Speak to financial advisors. In fact,
Yes.
do not
Mm,
speak to a singular financial advisor and go
nice.
just them. Go to multiple financial advisors and do
Yes.
your research and use your common sense.
Yes.
That is what we
Yes.
recommend you do.
Yes.
Because if you follow one financial advisor, quite frankly, I don't want to say you're an idiot. It's unwise to follow one person. Right? It's unwise. I don't like being that guy who offends people online. Do you know what I mean? It's unwise to speak to one financial advisor. It's unwise to blindly follow financial advisors' advice without consulting yourself
Yeah.
and do your own
Yeah.
research. That's also unwise. It's completely wise to get multiple opinions from multiple certified professionals with the piece of paper, right? And then doing your own research. And then we, a blockchain sensei, may contribute to your research. It's also completely unwise on the flip side to listen to only blockchain sensei, right?
Yeah.
So, yeah, I think moving forward, we should say, please consult multiple financial advisors, do your own research, and then come to your own conclusions.
Yeah,
Yeah.
I just think it's a bit wild
That is
to
the best way
go
forward.
into. It's a bit wild to have this idea in your head that you're going to retire in 30 years' time, 40 years' time, whatever it is, and you've only trusted one person ever in your life to sort
Crazy.
out your retirement, and you're not looking at it, you're not researching it, you're just like, yeah, one day it'll all be fine.
It's like, look, comparing money is like comparing what is comparing health, yeah, because health is wealth. Nobody is going to care about your money and your wealth more than you. Just like no one's going to care about your health more than you. So it's up to you. Let's just take money away. It's up to you to research what nutrition that you have to eat and what exercise plan is good for you, what sleep plan is good for you. And like no one nutritionist or no one personal trainer is gonna fix your fitness. Like you have to do the press ups, you have to do the reps. So if you just apply that logic with health and nutritionists and personal trainers to finances, hopefully.
But in this scenario, what's happening for most people is they are working with a personal trainer that has notoriously got most people killed by the time they're 45 or 50, and consists heavily of a diet of kebabs and McDonald's and cigarettes and beer,
Yeah.
and then parading around going, yeah, my results are great. It's like, how come most of your clients are finished? Like,
Yeah.
what's going on here? So yeah, that's what it is. But yeah, we'll just take some quick questions because we've got a bit of time for it. We'll go. Oh, Nahid, what are you saying, broski? Yeah, you've been unmuted.
He's only just joined, to be fair.
Oh, he's only just joined. Okay, no worries.
Okay.
Let's go, Toba. Toba, you've been unmuted. No worries then. Next, Asante, you've been unmuted, broski.
Obviously, always enlightening episode
Mm-hmm.
on a pension. Yeah, I got my question is you kind of answered my question about the moving average, the 200 moving average. You said you use the weekly and daily.
Mm-hmm.
But does that like accommodate for like dollar cost averaging as well?
Yep.
So like let's say I'm looking at PayPal or whatever, I don't start doing the dollar cost averaging until like the moving average, until the price goes above the moving average, basically.
It depends on your strategy. So for me personally, what I do is I keep a portion of cash. So when I'm invested, every time I get money, some of it goes to cash, some of it goes to investing. When I'm above when I'm above the moving average, not like that's when that's when I'm stacking the cash to then buy it when it's below the moving average later.
Okay.
So it's kind of it's a bit more complicated to use dollar cost averaging and the 200 moving average strategy. So yeah, I wouldn't recommend playing with the two. Just do one or the other. That's what I would say. But yeah, obviously you're part of the Mandem, so I've got some additional source for you that anyone that's doing any lessons, I've got a moving average strategy that I haven't really shown anyone before. So yeah, I'm happy to go over that with you, Vicente.
There. Always appreciate you guys, man.
No worries, bro.
So my mind is blown, like bun a pension at this point, fam.
Yeah, it's a bit of a sad situation, isn't it? It's a bit of a sad situation. Let's go to Professor Keash Black.
Yeah, I see you active in the comments, man.
It was good. It was good, team. Always a pleasure and a privilege. It's been a while since I was able to join on. But yeah, sessions on pensions are a key topic which we don't pay enough attention to, and I kind of learned the hard way. So if you wouldn't mind, maybe I share an example, a bit of a war story. Yeah. So like probably most people on the call, I started work at the age of, I don't know, it must have been 23, 24. And from that age, I just didn't want to do anything with the pension at all. Because I kind of understood that to a certain extent, it is a bit of a Ponzi scam, like everything else is a Ponzi, in the sense that my contributions were being used to technically pay off those who are retired. Yeah? And that's how a number of pensions operate. You know, they need constant flow of new contributions. So look, I had that limited mindset. I didn't have somebody school me and sit me down and educate me on the game. The only thing somebody did tell me was the first pound that you invest in a pension works the longest for you. Yeah, the first pound that you invest works the longest for you. But anyway, that was, still a good few years off. It wasn't until I went to work in Kenya, and whilst I was there, I had the opportunity to also invest in a local pension scheme. But once again, somebody didn't sit me down and educate me properly, because whilst I was there, I could have contributed into a pension scheme, and by the time I was leaving 3-4 years later, I could have taken 75% of that pension as cash.
Oof.
Yeah, this is both my contributions and my employer's contributions as cash.
Oh,
and
wow.
when it hit me, I was like, what? Because I spoke to my employer then, and they're like, nah, it's not worth you doing it because you're not going to be around. So this is why, we talk about seeking advice.
So you took a 25% loss on your cash?
Bro, more than that. My employer was matching, I think it was like 10% contribution.
Oh.
Yeah. So I missed out on 3 years worth of minimum 3.5 worth of contributions that I could have taken out as lump sum tax free.
And then you could have invested that elsewhere.
There you go. So, like I said, I learned the hard way. As soon as I came back to the UK, I made sure I steadied up on the game and made sure I invested again. Now, obviously, your dynamics will change as people grow, family circumstances, you get married, have kids, etc. Right? So different responsibilities come. But the key thing is also just understanding the point around where your underlying pension is invested. And that's a point that I know Michael touched on, but people really need to understand that if you are going to put money into a pension, you need to know where that money is being positioned, whether it's been played as a pawn or whether it's been played as a queen. Because if you don't know the strategy that your pension fund administrator is using, they're probably just lining their pockets only.
Yep.
And there
You
are
know what's
platforms.
crazy? The best thing that you said there, and I just imagined it, is that when you enter, I'm just paraphrasing you in what I got in my head. When you enter a pension fund, you are providing exit liquidity.
There you
Oof.
go. There you go.
Yeah.
I told you that's the game. Yeah,
Exit
that's what I'm
liquidity
saying.
for the 65, 68-year-olds that are ready
100%.
to pull out.
Yeah.
Yeah, that I learned that at the early age, and that's why I didn't get into it. Yeah, because that's what you're doing. You're putting liquidation into the mix, and people won't tell you that side, but that's how the game is played.
And they don't
Especially-
care. They don't care because
Especially-
they're not going to be alive or around when you come to get your retirement.
So the reason why, let me just maybe share some insight. So the reason why, not a reason why, but a few years ago, let's say maybe 10, 15 years ago, right? A lot of companies were offering final salary pensions. Just think about that. Final salary pensions. What does that mean? Whatever salary you were on with that company when you retired, technically that is what you would earn for the rest of your life.
Mad.
Yeah. In
How's
a
that even
broad,
possible?
in a broad scheme of things, that's what it meant, a final salary pension. So ask yourself, how could pension companies generate enough income, enough growth and gains to fund those liabilities?
You can't.
Hence why
Unless
you
you're getting
saw,
crazy gains on the market, which they're not.
hence why you saw or you've seen that final salary pensions no longer exist anymore, right? If you're with a company, the best you're gonna be able to get is what they call a final. It's not even final. It's like a contribution. So basically, you contribute a certain amount over the period that you're working with them. They put that amount into a pot, a general pot, and it's invested. And it's how that pension fund performs that determines what you get out. Yeah. So I think it's like a contribute. I forgot the term. It'll come to me. So the money right now is, put into a pot, and how that pension fund performs is what you get out when you come to retire. Which is why when Don't Trust Lizzie and Kwasi Kwarteng did what they did and nearly broke the pension funds of a number of companies, they were technically bailed out in that period of time when the pound dropped. The pension deficits that came up were shocking and were enough to literally force a number of companies to go under.
It's going to happen again.
So say that again.
I said it's going to happen again.
It's definitely possible. It's definitely possible. One of the biggest liabilities that listed companies will have on their books is their pension fund.
Mm-hmm.
And how to meet those obligations. You've got governments, or should I say councils, etc., are always, at the lobbyheads of strikes, etc., because the workers or the unions are looking to way to ensure that their pensions are protected. Anyone here work for the government or a council?
Don't think we got anyone, no. Not in this call.
Okay, because basically how pension schemes for like the council and the government's work is also a bit crazy, man. It's not based on how the stock market performs. They just give you a formula at the start and they pay you whatever. Now, to most people, it's like a risk-free approach because typically the employer contributes something as high as like 15, 18, 20%, 25% in some places. Yeah? So it's tax-free money without a doubt. But it's not performance linked in terms of stock market. It's just a standard, maybe 2%, 3%, 5% if you're lucky growth over the period of time. But there's a lot of stuff around pensions, and without a doubt, add it to your investment portfolio investment horizon. There's a whole different game that can be played when it comes to investing in pension for your kids.
There we go.
Investing in pension for your kids. If anyone's got kids on this call, imagine compound growth over 55 years, even if it's at 2%.
Yes, this is the game. Yes.
That's the real game that's been played by those who know. Right? You can put in something like £2,800 for your child, not touch it again for the next 50 years.
Yep.
Do some numbers based on 15%, 10%, 5%, 20%, 30% compound growth, and you see what you end up after 50, 55 years.
Exactly that. That's a fact. Because typically it would start at the age of 18 or around about early 20s. And that's basically 25 years of compound interest that has been established.
Nah, longer than that, bro.
Yeah.
Mad.
I'm saying if you've got a child right now, you can open a pension fund for your child.
Regardless of their age?
Regardless of their age.
Woo! Woo!
That's what I'm talking about, 55 years of compounded growth, because that's how long it'll be before they retire. Now, a lot of people will think about it and think that's a long time, but just think, one lump sum contribution, £2,800, the government even tops it up for you to 3,600 and just let it sit there for 55 years.
Yeah, that's crazy.
But hey, there's a lot on this topic. I'll share some other stuff in the Grams group. But yeah, definitely.
That's this episode is.
Wait, guys! Nahid has been waiting there for so long.
Go on, Nahid.
He's been waiting with his hand up for so long.
Look, this conversation is jokes because I'm not gonna lie, I think pensions are like outright scams. This is coming from someone who's actually worked for a pension fund. Now,
Let the game. He's been waiting for ages.
I'm gonna tell you one thing. Yeah, what are the two ways governments control people?
Pension and property, isn't it?
No. Tax and religion. So if they're not controlling you based on what you can do in terms of religious beliefs, then they're controlling what you can do in terms of your money flow. Now, do you know what the history of the pension is?
Nope.
So in the Roman Empire, so you have your legions and your army people and whatnot. They're fighting for you in the Roman Empire. Now, these soldiers have just come back from war after 15, 20 years, and they're sat there going, bruv, what do we achieve for 20 years beside, like, of course, they can't describe it as mental problems, but all we've done is take on, like, you dickhead, all your problems for 20 years. What do you give us? So just to stop these men revolting and, like, taking over, overthrowing them, they introduced the pension. And who pays for the pension? The normal people. It comes from people's wages. It doesn't come out of the emperor's pockets. It doesn't come out of his own personal treasury. It comes out of the people, and they justify it. These men have gone out and fought for our interests, so we need to pay them a tax. But why are we paying the tax? They're not protecting our interests. They're protecting your interests. You just happen to be the dickhead that sits on the throne and claims we somehow let you along with it.
So mad, I never even
And what's so mad is after the fall of the Roman Empire, pensions weren't thought about for centuries. And then when it happened again was in the rise of the German Empire. So in the 19th century, if anyone's heard of Otto von Bismarck, he was basically like, if it wasn't for Bismarck, there wouldn't be no Hitler. But Bismarck, if you have a look into him, when he was unifying Germany from, the Saxon Empire and all the other different, empires within Germany, and he brought them together as one country. One of the main ways he did that was appealing to the older generation.
Yeah.
Most of these older generation of people, they'd all just basically have been spending the last 200 years working post-industrial revolution. So that is tough work. If you spend 50, 60 years, working in the mines, working in employment like this, it's fucked up. So he was the first person who saw an opportunity here to get these people behind his back so he could unify Germany. And his proposal was, if we, as ancient Germanic people can come together and unify as one country, every single person is over the age of 60, you will get a tax from the younger people. And like Ninja said, it's exit lick. It's straight exit lick. And it's, it's the promise.
It wasn't me. It was Prof Cashback.
Bro, it's
I was
straight
just quoting
think
it.
about it. They're telling all the 6-year-olds today, vote for me today because we're gonna make the 20-year-olds pay for you today. And you're saying to the 20-year-olds, like, vote for me because 60 years from now, I'm gonna make sure the next bunch of 20-year-olds will pay for you. And that works. You know, that does work when like people don't have the technology and the capacity to plan for their own future. But in particular today, when you can go out and use your phone, sign up for Trading 212, something as simple as Revolut, Binance, whatever, and trade from your own pocket, like, why do you need a pension? In particular, the reason why, now I'll come to a bit my own background. So I've worked within a pension scheme. I'll show you the company that I used to work for.
Bro, man's got all idiot, yo.
They're called Payden.com. Go to their website. They're basically one of the largest investment management firms, like private investment management firms globally. Now, they wouldn't tell me exactly who some of their clients were, but they had like, I know for a fact, based on some of the conversations, they had like schools, they had like universities. So imagine, for example, you as a teacher, your school has to give the pension to someone. It has to choose a management firm to hand all that money over to. And I don't know if anyone's from so the standard is there's this thing called 220. So every VC fund, every alternative investment management fund, pension fund, they all have this system called 220, which basically means the person managing it, they take 2% fees and they take 2% carry on any profits that the fund makes. So imagine why you're sitting there working away, some waste man out there, just because he's managed to I don't know, rub up to the right people, is sitting there collecting 2% fees on your pension, and then any carry he's making 20% on it. And it's a no-brainer. Like the assets they're investing into are, things like the S&P 500, the same shit you can invest into yourself. And they're taking a 2% fee and a 20% carry on that. What, you can't go out and join a blockchain sensei Monday night event just to learn how to do it yourself? It's a no-brainer. And it's so stupid because think about that. When you give these man your money, it's legit locked away for the next 50, 60 years. If you pass away today, God forbid, 10 years from now, the only way you can get your pension back early is if you have life insurance, because the life insurance will take it out for you now and they'll collect it later on.
Wait. Just for the record, let's say somebody's working for 18 years, from 18 to 36, and then they unfortunately die before they're 40. That 18 years of pension money, does that not go to their family?
Not always. Depends on the company. So there's actually, I only learned this recently because it was one day there's this lady, I don't know if anyone's spoken to Cher, but she's the old Asian lady. She used to come along to the DLT hub. Now, this woman was the first person, she was speaking to me about it. So her husband passed away and he used to work for BP. Remember, Big BP. His pension was with Big BP. The man passed away before his pension age and they won't release the pension to her. They're saying to her, you got to wait until he's
mad.
To you.
Mad.
My husband's passed. I do not have life insurance. So you're telling me the only way I could have collected that pension early is if my husband had life insurance. So now you're telling me to get my Ponzi scheme. You want me to invest into another Ponzi scheme. So the way they just wrap it up and create, it's pointless, especially today. I'll tell you the reason why I don't invest in a pension scheme. When my employer tells to me, hey, do you want us to join our company?
I also do not. My last pension contribution was 2018.
Think about it this way. If you're gonna put £100 into your pension, you're not seeing that P for the next 50, 60 years. God forbid something happens to you, your family might not bloody see it. And worst case scenario, the entire world's going to shit anyway. So who knows what's gonna be the next 50, 60 years. So my thing is, honestly,
94% tax.
Everyone put some fire emojis in the chat for Naheed. He has just come in and lit this up.
Bro,
and Professor Cashman
if you got £100 spare, the way I see it, your pension money, you're never seeing it. That's the way I can look at my pension money. So if my employer was going to collect £100 pension from me, I'm not seeing that money ever. You know what I'd rather do? I'd rather go on KuCoin, look at the top 100 metaverse coins, dump it in there, bruv. Because think about it, the odds of you getting that money back, realistically, look, forget the statistics are biased anyway. Bro, I'll go to the top 100 KuCoin coins and see, what can I slap my dough in to see what's going to take me to 100x? And realistically, it will outperform my bloody pension. Think about it. Yeah, NFA.
Yo, this episode is gonna get us in trouble.
Yeah, Pepe, bruv. Yeah, go buy some Pepe, bruv. Don't give the government your money.
Don't buy, don't
Don't
do
buy
that,
Pepe.
guys.
Maybe.
Go buy Pepe. That was actually a joke. That was actually entertainment.
Like now in my experience, it is too late. Don't do it. There's way better places to put your money.
But yeah, bro, that's mad. I didn't even think about like if something happens to you that your family can't get it. That is maximum violation. Like, oh, that got me so angry and emotionally moved when you said that. Like, oh, what a scam. Yo, it's mad. Right, guys.
I dropped one more thing in before you
Oh,
end.
don't
You work for Woolworths, bruv. Imagine you're some old lady, you worked at Woolworths your entire fucking life, your local shop. Like you grew up in that village, whatever. You worked at Woolworths. It's it 2005, 2006. You're hearing they're going bankrupt, and guess who the first like creditors are? Not you. Your pension scheme, like it's gone. It's not there.
Now, do you know what?
God.
This is actually why I got into investing. Is one of my friends from uni. She got a job working in white collar crime. So one of the first cases she had that she used to discuss with me was British home stores. So she knew British home stores was going bust before they went bust 2 years before, because she'd seen that they were doing some mad rogue trades with the pension money. So she was like, yeah, we're investigating them and we know that they're going to go bust. So 2 years later, they've gone bust. And I'm like, yo, that's mad. All of them people that were working there for a big 40, 50 years, pension gone. Like, that's mad. Like, I just personally think it is too risky to trust anyone but yourself with your pension. Like, it's just too risky. It's too risky. Like, at least if I F up, it's on me, innit? Whereas if I'm trusting some next guy that I've not even ever met, has never met my family, nah, I'm not. Nah. It's mad. It's mad. Right, guys. This chat has been crazy. 46 comments in the chat. It's going.
It's
going
really engaging.
mad. He's still got in them. The only people that win in the middle fuckers like Payden.com. Wow, he's got it in. Yeah, mic drop. This episode has been absolutely
Sensational.
Legendary. Big love. Yeah, Naheed coming through with the drive-bys. Thank you to everyone who's attended today. Thank you, Naheed. Thank you for everyone that's attended. Thank you, Professor Cashback, for opening up that door and allowing people to drop their fire. Yeah, man. God bless. Go do your own research. Yeah, man. Go do your own research. That's the only one. Anyone watching this back on YouTube, we're Blockchain Sensei. We only drop this. We drop fire like this every week. So yeah, man, come join us. Tell a friend. Also, I think this is an episode where people should share it with friends. Personally, I think you should share this episode with friends.
This is one of the ones you can
family. This is one where you can show it to family. This is one where you can show it to aunties, uncles, so on and so forth, and just go. Have you ever had a conversation with anyone about your pension? Because this is one thing that I noticed doesn't happen in UK family units. When I was in the Middle East, that's a top yo. That is a straight family conversation. People are having that conversation, but they're not talking about pensions there because it's different. But yeah, man. So bless up.